You did everything right. You didn't chase hot stocks. You didn't panic sell during crashes. You didn't listen to the colleague who swore his crypto pick would change your life. You opened a low-cost index fund, set up automatic contributions, and left it alone. For 35 years, that single decision quietly built your wealth. Then one morning you sat down, opened your portfolio, and looked at the actual breakdown. Not the total return, not the percentage gain. The real structure of where every single dollar was sitting. What you found didn't make you feel proud. It made you want to change everything immediately. For most of your investing life, your answer was simple. S&P 500 index fund. Low fees, automatic contributions, leave it completely alone. The logic felt clean and unbeatable. Instead of picking individual winners, you buy a small piece of the 500 largest companies in America. When some fail, others carry the weight. The overall market grows and you grow with it. No stock picking stress. No expensive fund manager quietly eating your returns. Over the past century, this approach averaged just over 10% annually. Not every year. Some years you lost badly, some years you gained enormously. But across decades, the line always moved up and to the right. You used it. It worked. You became wealthy doing exactly this. But here is what you missed hiding inside those numbers. You always assumed the S&P 500 meant your money was spread fairly across 500 companies. That assumption felt safe. 500 different businesses, 500 different industries, 500 different futures protecting you from any single failure. Then you looked at the actual breakdown and everything shifted. Today, roughly 40% of a typical S&P 500 index fund is concentrated in just 10 companies. Those companies are Nvidia, Microsoft, Apple, Alphabet, Amazon, Broadcom, Meta, Tesla, Berkshire Hathaway, and JP Morgan. This reflects the approximate weighting of the S&P 500 as of 2025. Nvidia alone receives between 7 and 8 cents of every dollar you invest. One semiconductor company holds nearly 8% of your supposedly diversified portfolio. This happens because your index fund is market cap weighted. The more valuable a company becomes, the larger the slice of the fund it automatically controls. There is no manual correction, no rebalancing committee, no limit. Size feeds size. The bigger they grow, the more passive investment flows toward them, which makes them bigger still, which attracts even more money. Now here is where it gets genuinely uncomfortable for you. If you remove Berkshire Hathaway and JP Morgan from that top 10, what remains is a group of companies sharing one very specific characteristic. They are all making enormous, debt-financed bets on the exact same technology, artificial intelligence. For these companies to justify their current market valuations, they would collectively need to generate around $2 trillion in revenue. To feel the weight of that number, it exceeds the combined total revenue of Nvidia, Microsoft, Apple, Alphabet, Amazon, and Meta. Across all of 2024, combined, your portfolio is not pricing these companies on what they earn today. It is pricing them on a future that has not arrived yet, built entirely on one technology delivering at a scale nobody has ever demonstrated. You are not holding 500 companies. You are holding one concentrated bet, dressed up as diversification. You have seen this pattern before, not with AI, but with the certainty underneath it. Think about what investing felt like in 1900. The United Kingdom was the financial center of the world. British companies dominated global trade. The empire stretched across every continent, and London was where serious capital lived. If you were investing then, placing everything into British companies would have felt like the most logical, safest decision imaginable. Betting against Britain would have seemed almost irrational. That is not how the next 100 years played out. You saw the same thing happen with Japan in the late 1980s. Japanese companies were dominating electronics, automobiles, and technology. The American economy was dealing with high inflation and slowing growth. Serious investors were moving toward Tokyo, and the conventional wisdom was shifting fast. Japan looked like the undeniable future. Then America came back. Completely, overwhelmingly, and for decades. This is the only pattern that has been consistent across 2 centuries of market history. Leadership changes. Economic dominance shifts. No country, no sector, and no technology stays on top permanently. The one thing that has always been certain in markets is that certainty itself eventually becomes the most dangerous thing you can feel. Which means right now, when investing only in the S&P 500 feels like the obvious intelligent choice, history is quietly reminding you that obvious and safe have never meant the same thing. When your entire portfolio lives inside one country's market, you miss companies like TSMC, Samsung, Toyota, Tencent, AstraZeneca, and HSBC. These are not speculative bets. These are global businesses operating at enormous scale, generating real earnings every quarter, and excluded from your portfolio purely because of where their headquarters are located. a globally diversified fund covering developed and emerging markets across more than 45 countries, automatically adjusts as dominance shifts. If America continues leading, your portfolio reflects that. If another economy begins outperforming, your portfolio adjusts for that too. You stop betting on geography and start owning the actual direction of global growth, wherever it moves next. The most profitable angle of AI is the one most investors around you are completely ignoring. The crowded trade right now is straightforward. Invest heavily in the companies spending the most money building the most powerful AI models and assume that whoever spends most wins most. Nvidia, Meta, Microsoft. This is where the majority of investment sits today, including yours through passive indexing. But ask yourself a different question. What if the AI race ends not with a winner, but with a commodity? What if these models become so capable and so similar in quality that the only deciding factor for most users becomes price? You already see this happening in software right now, where startups let users switch freely between Claude, ChatGPT, and Gemini based purely on cost and convenience. Think about petrol. One station sells standard fuel cheaply, another sells marginally better fuel at double the price. Most people fill up at the cheaper station, not because they cannot appreciate quality, but because the difference simply does not justify the premium for everyday use. When technology becomes good enough and interchangeable, value does not stay with whoever spent the most building it. Value flows to whoever deploys it most intelligently at the lowest cost. That is a completely different game. Small and mid-cap companies do not need to win the AI arms race. They just need to apply the technology to real problems without carrying billions in infrastructure debt. If your thesis on AI commoditization proves correct, your upside from this position is enormous. If you are wrong, your downside is contained because your core S&P 500 position still captures the growth. This is not gambling. This is positioning yourself on both sides of an uncertain outcome. You probably think of gold the way most investors do, an old-fashioned hedge, something your grandparents held. Interesting historically but not particularly relevant to your modern portfolio. That thinking made sense before 2025. It doesn't anymore. Here is what changed and why it matters specifically to your money. Gold was reclassified under Basel III regulations as a Tier 1 asset. Before this change, your bank, every bank, was restricted from counting gold at full value on its balance sheet. Now your bank can treat gold exactly like cash or government bonds. One regulatory change, one line in a global banking rulebook, and suddenly every major financial institution on the planet has a structural reason to hold more of it. You cannot print more gold to meet that demand. That is the part that should make you sit up. You can already see what this is doing to the numbers around you. Gold has overtaken U.S. Treasuries as the largest foreign reserve asset held by central banks worldwide. For the first time this has happened since 1996, the Bank of America published new guidelines telling institutions to move their gold reserves from 20% toward 30% of total holdings. You might think that 10% shift sounds small. Multiply it across the entire global banking system, and you are looking at a demand increase that has no supply response available. And then look at what Warren Buffett is doing right now. The most disciplined investor alive is sitting on $347 billion in cash. He is not deploying it because he sees no valuations that justify buying at current prices. When the person with the best long-term investment record in history is building cash rather than buying assets, you should be asking yourself whether your own cash position reflects that same discipline. Your cash is not sitting idle. Your cash is waiting. It is the tool that lets you act decisively when everyone around you is being forced to sell. Your S&P 500 position stays. If AI delivers on its promise, the leading companies will compound that growth and you benefit directly. Abandoning it entirely means surrendering the upside of being wrong about concentration risk. But alongside it, your global allocation now reflects the reality that economic dominance has always moved and nothing suggests it stopped moving in 2025. Your small and mid-cap exposure captures companies quietly deploying AI without the debt burden of the giants currently dominating your index. Your gold position is small, strategic, and built on institutional logic rather than fear. And your cash gives you the ability to act decisively when everyone else around you is paralyzed. You spent 35 years doing the right thing. The question now is whether the right thing in 2025 looks identical to the right thing in 1990. Your numbers already answered that question. You just had to be willing to look at them honestly.